Welcome back to the channel, traders and financial enthusiasts. Today, we are opening up the curtain on one of the most eye-opening, brutally honest books ever written about the foreign exchange market. We are taking a deep dive into Beat the Forex Dealer by Agustin Silvani. If you have ever felt like the retail foreign exchange market is actively rigged against you, or if you have ever had a stop-loss hunted down to the exact pip before the market violently turned in your favor, today's summary is going to explain precisely why that happens. Grab your favorite drink, settle in, and let us unveil the hidden mechanics of how foreign exchange brokers and institutional dealers really operate behind closed doors. Agustin Silvani spent years working on the inside of the financial industry. He has sat at the institutional desks, managed real money, and seen exactly how retail foreign exchange dealers treat their retail clients. His book is not a standard, boring overview of moving averages or simple chart patterns. It is an insider whistleblowing manual designed to show you how the game is actually played, who your real counterparties are, and how you can stop being easy prey for the predatory dealers who profit from your mistakes. Let us break down this captivating story step by step. The illusion of the retail foreign exchange market. To understand how to win in the foreign exchange market, you must first shatter the massive illusion that most beginners fall for when they open their very first trading account. Most retail traders believe they are directly interacting with a massive, pure, global decentralized marketplace, where their orders are seamlessly matched with other buyers and sellers around the world. Silvani makes it crystal clear right off the bat that this is almost never the case for the average retail trader. When you trade foreign exchange through a standard retail broker, you are usually not trading on the real interbank market. Instead, you are trading in a closed loop created by your specific broker. In industry terms, your broker is often acting as the dealer, the market maker, and the direct counterparty to your trade. This means when you click the buy button on your platform, your broker is effectively taking the sell side of that exact trade. Think about the profound conflict of interest this creates. If your broker is taking the opposite side of your trade, your financial gain is their direct financial loss. Conversely, your complete financial loss goes straight to their bottom line as profit. Silvani pulls back the curtain on the B-book model, where brokers actively aggregate retail traders into groups. Since the vast majority of retail traders lose their entire account balances within their first few months of trading, the dealer does not even bother hedging your trades in the real market. They simply sit back, take the opposing side, and wait for you to inevitably blow up your account. Understanding your enemy, the retail foreign exchange dealer, Silvani introduces us to the personality, objectives, and mechanical tools of the foreign exchange dealer. The dealer is not a cartoon villain. They are simply a business entity, executing a highly profitable business model based on retail human behavior. Dealers analyze their client base meticulously. They use sophisticated internal risk management software that categorizes traders into different buckets based on their historical performance and trading habits. If a client is identified as a typical, uneducated retail trader who overleverages, trades emotionally, and fails to use proper stop losses, they are assigned to the internal dealing desk. The dealer knows with statistical certainty that this group will wipe out their capital over time. The dealer takes zero market risk against the real interbank market because your money simply stays inside the broker's vault when you lose. On the other side of the spectrum, if a trader shows consistent profitability, tight risk controls, and sharp market timing, the dealer recognizes them as a threat. The broker will move this sharp trader to an A-book model, passing their trades directly to real institutional liquidity providers, or hedging the risk in the broader interbank market. The core theme of Silvani's book is teaching you how to transition your trading style from being an easy target for the B-book to becoming a sharp trader that forces the dealer to respect and hedge your positions. The weapons used against retail traders. Now that we know the conflict of interest exists, let us discuss the specific, often brutal tactics that dealers and market makers use to exploit retail traders. Silvani explains that because the retail foreign exchange market lacks a single centralized exchange like the stock market, prices can vary slightly from broker to broker. This gives dealers immense flexibility in how they, quote, bid and ask prices to their clients. One of the most common weapons is spread widening. During major economic news events, high volatility or low liquidity periods like the market rollover, dealers will drastically widen the spread between the buy price and the sell price. A spread that is normally 2 pips can suddenly balloon to 15 or 20 pips in a split second. This artificial widening instantly triggers protective stop losses that were placed too close to the current price, liquidating retail positions before the real market price even has a chance to move. Another major tactic is stop hunting. Dealers possess complete visibility over their internal order books. They know exactly where thousands of retail traders have clustered their stop-loss orders, usually just above obvious swing highs or right below obvious swing lows. Because liquidity accumulates around these clusters, dealers have a strong financial incentive to push the price quotes just far enough to sweep those stops, absorbing that liquidity before letting the market resume its actual path. Silvani emphasizes that what retail traders see as bad luck is actually deliberate liquidity engineering by market participants who can see all the cards in your hand. The deadly traps of retail trading habits. Silvani spends a significant portion of his narrative pointing out how retail traders actively hand their money to the dealer on a silver platter through terrible habits. The dealer does not even need to manipulate the market most of the time because retail traders defeat themselves through pure behavioral psychology. The first major self-inflicted wound is excessive leverage. Retail foreign exchange brokers often advertise massive leverage, allowing beginners to control huge position sizes with tiny margin deposits. High leverage acts like a financial weapon with no safety catch. It magnifies every single micro fluctuation in the market, causing emotional panic at the slightest drawdowns. Retail traders over-leverage, panic at a small retracement, close their positions at a loss, and watch in frustration as the market immediately turns back in their intended direction. The second major habit is asymmetric risk-reward behavior. Retail traders tend to cut their winning trades extremely short out of fear of losing a tiny profit, while holding on to massive, soul-crushing losing trades in the naive hope that the market will eventually break even. Silvani points out that dealers love clients who exhibit this behavior. The dealer collects quick spread fees on the small wins and eventually inherits the entire trading account when the giant losing trade inevitably gets margin called. Thinking like an institutional market participant. To beat the foreign exchange dealer, you must completely stop thinking like a retail chart reader and start thinking like an institutional operator. Institutional traders, hedge funds, and bank dealers operate in a world defined strictly by liquidity, order flow, and big-picture fundamental drivers. They do not care about a random 5-minute indicator cross. They care about where they can fill massive order blocks without causing catastrophic slippage. Silvani stresses that big market players cannot simply enter or exit a multi-million-dollar currency position with a single click of a button. They need counterparties. If a hedge fund wants to buy a massive amount of euros, they actively need a huge pool of market participants willing to sell euros to them at that exact moment. Where do they find that selling pool? Right at the level where thousands of retail traders have set their sell-stop orders below a major support line. When you learn to view price charts through the lens of institutional order flow, support and resistance levels transform into target zones for liquidity sweeps. Instead of placing your buy order right at a support line like every beginner textbook tells you to do, you wait for the market to aggressively break down below that support line, sweep the retail stop losses, absorb the panic liquidity, and show clear signs of institutional rejection. By entering the market alongside the big institutions after the sweep occurs, you are aligning your capital with the real movers of the market rather than becoming their financial fuel. Core strategies to defeat the dealer. Silvani outlines specific, high-probability trading concepts designed to capitalize on dealer behavior and retail predictability. One of his favorite environments to exploit is the post-news market reaction. When major macroeconomic data drops, the initial price spike is often a chaotic, low-liquidity knee-jerk reaction that sweeps stops on both sides of the market. Instead of trying to predict the news or gamble on the initial explosive candle, Silvani advocates for waiting for the dust to settle. Let the dealer widen the spreads, sweep the obvious stops, and trap early breakout traders. Once the initial manic move exhausts itself and price begins to stabilize, look for fade opportunities where the real institutional direction reveals itself. Fading false news breakouts allows you to enter with incredibly tight risk parameters while trading in the direction of the underlying fundamental trend. Another core strategy involves identifying order flow imbalances around key market sessions. The foreign exchange market operates 24 hours a day, but key financial hubs like London and New York dominate the actual volume. Silvani highlights how the Asian trading session often creates a tight, predictable trading range due to lower volume. When the London session opens, institutional dealers frequently push price outside the Asian range to grab liquidity before driving the market in the true direction of the day. Recognizing this classic London break and reverse pattern allows sharp traders to avoid getting trapped by early morning fakeouts. Bulletproof risk control and position sizing. No strategy in the world will save you if your position sizing and risk control are broken. Silvani devotes critical focus to the absolute necessity of mathematical discipline. He reminds us that the primary goal of trading is not making money today. It is surviving long enough to let your statistical edge compound over time. You must treat every single trade as an isolated event with a completely uncertain outcome. To protect yourself from unexpected dealer spread widening, slippage, or sudden market gaps, your position size must be scaled down to a point where a losing trade causes zero emotional distress. Silvani strongly advises risking only a tiny fraction of your account on any single trade setup. Furthermore, you must place your stop loss at a level that invalidates your technical thesis, rather than choosing an arbitrary dollar amount you are comfortable losing. If placing your stop loss at a safe, logical level requires risking too much capital, the solution is simple. You reduce your lot size down until the math perfectly aligns. When you master proper position sizing, you render the dealer's stop hunting tactics completely ineffective against your account because your trades have enough breathing room to withstand market noise. Developing the psychological edge of a winner, beyond the mechanics of dealer operations and technical setups, winning in the foreign exchange market requires profound psychological mastery. Silvani observes that retail traders fall into predictable mental traps because human intuition is fundamentally wired backward for financial markets. In normal life, when something goes wrong, human instinct tells us to hold on, negotiate, and try harder to fix the problem. In trading, holding on to a bad position leads to complete financial destruction. You must learn to embrace being wrong as a completely routine cost of doing business. When a trade fails, you cut it immediately without hesitation, ego, or regret. A winning trader operates with total emotional detachment. They do not get euphoric after a profitable trade, nor do they get angry or seek revenge against the market after a losing trade. They accept that the dealer is simply an entity doing its job, and their own task is to execute a disciplined trading plan with military precision. When you remove fear, greed, and revenge from your decision-making process, you eliminate the very emotional vulnerabilities that dealers profit from every single day. Final takeaways for the modern foreign exchange trader. Agustin Silvani's Beat the Forex Dealer is an absolute masterclass in market realism. It strips away the polished marketing promises of the retail brokerage industry and exposes the true, competitive nature of foreign exchange trading. By understanding that your broker may be your direct counterparty, recognizing how liquidity sweeps operate, and building strategies around institutional order flow, you transform yourself from a statistical victim into a sharp, street-smart market participant. To wrap up our journey today, remember that defeating the dealer is not about finding a magic indicator or a secret trading system. It is about understanding the incentives of every participant in the ecosystem, protecting your capital with ruthless risk management, and having the discipline to wait for high-probability setups where the odds are heavily stacked in your favor. Thank you so much for watching this comprehensive book breakdown today. If you enjoyed this insider look into how the foreign exchange market really works, please give this video a like, subscribe to the channel for more high-value financial content, and drop a comment below letting me know what surprised you the most about how dealers operate. Trade smart, manage your risk, and I will see you all in the very next video.